Good afternoon, guys. This is discussion A, and we are discussing. Um, I will tell you in a second. We are discussing 11 alternative strategies to fund long term care. Okay, so here we go. The article outlines 11 alternative strategies to fund long term care without dipping into retirement accounts. Here's a summary of the first and most highlighted approach: reverse mortgage, turning home equity into care funds. Who qualifies? Homeowners age 62 plus. What what it does: converts home equity into cash via lump sum monthly payments or a line of credit without monthly mortgage obligations. Benefits: preserves IRAs and 401ks, funds home based care and modifications. Offers a growing line of credit that adjusts with raising care costs or rising care costs. Things to watch: interest and fees, reduce home equity over time, must keep up with taxes, insurance, and maintenance, lenders' assets. Lenders assess your finances and property. Here's here's can hers can replay the loan via sale or refinance, or keep the home if they settle the balance. A HUD approved counselor is recommended before signing. Would you like a breakdown of the remaining 10 strategies too? Some may intersect with your interest in equitable aging solution and memory friendly housing design. Absolutely. Here's a concise summary of the 10 remaining alternatives to fund long term care without tapping into retirement accounts. 1. Home equity line of credit offers flexible, low interest borrowing, what requires repayment unlikely reverse mortgages. 2. Sale leaseback agreements. Sell your home and lease it back to stay living there. Assets, uh, equality while maintaining residence. 3. Accessory dwelling units, ADUs. Next one, build or rent out a secondary home on your property. Uh, Generates rental income to offset care costs. 4, long-term care insurance, or LTIC or LTCI, pays for services like home care or nursing facilities. Policies vary widely in coverage and costs. Life insurance with long-term care riders accelerates death benefits to cover care. Some policies include chronic illness benefits. Let's see, uh, vital or life settlements. Sell your life insurance policy for cash. This is how, guys, like I said, we're discussing alternative ways to pay for care. Okay. Best for those with serious illnesses and limited options. Annuities with long-term benefits. Converts savings into guaranteed income plus LTC coverage. Can protect against rising care costs. Medicaid planning. Structured asset transfers to trust to qualify for Medicaid. Must navigate complex legal rules and timelessness. Renting out property. Passive income source can help preserve other assets while funding care. Okay, 10 family agreements or shared care agreements. Formalize family caregiving with compensation. Promotes clarity and fairness among relatives. Each strategy has its own risks, regulatory hurdles, and suitability based on individual circumstances. Given your interest in equitable aging and memory friendly housing options like ADUs, sell lease back, and family care agreements could be especially relevant for shaping inclusive care environments. Would you like to compare a few of these more closely? Could I build a pros and cons chart? Based on different care goals, you're asking exactly the right question, Felicia. Each strategy has trade-offs depending on the person's financial situation, long-term care goals, and family dynamics. Here's a breakdown of potential downsides to consider for each option. Home equity line of credits requires monthly payments, which may be difficult on fixed income. Variable interest rates can raise unexpectedly risk of foreclosure if payments aren't met. Sell back lease agreements, loss of full owner, loss of full home ownership control. lease term Lease terms might not be favorable. Long term emotional impact of selling your home while still living in it. Accessory dwelling units, ADUs, high upfront construction costs, and zoning hurdles. Rental income isn't guaranteed. Many require ongoing property management. Long-term care insurance can be expensive, especially if purchased later in life. Let's see. Details or delays in claims if documentation isn't airtight. Premiums may rise over time, or benefits may not keep pace with costs. Life insurance with riders reduces death benefit if hers when used for care. Riders may not cover all care types or durations. Can be more costly than traditional life insurance. Uh, uh, Vital life settlements offers less than full face value of policy, may affect Medicaid eligibility or tax liabilities. Typically only viable for those with serious illness, annuities with LTC benefits. Can be complex financial products with limited flexibility. Poor liquidity, hard to access funds in a pinch. May have high fees and less transparency. Medicaid planning, time sensitive and legally intricate. Improper planning can trigger penalties. Asset transfers must occur within specific look back windows. Not ideal for those with significant assets they wish to preserve. Renting out property requires upkeep and management, which might not be feasible. Vacancy risk or unreliable tenants can disrupt income, may not generate enough revenue depending on location and market. Family care agreements can strain relationships if terms aren't clear or expectations shift. May need formal legal documentation to prevent disputes. Payment could affect Medicaid rules or family dynamics. Okay, so here's the bottom piece, one of them. Would it help if I group these strategies based on financial risk, family involvement, or legal complexity? That way you could better align them with the equitable and I don't know, autonomy centered care models you're passionate about. Each strategy offers different strengths depending on a person's financial landscape, care needs, and goals around autonomy and aging in place. Here's a breakdown of key benefits for the 11 long-term care funding strategies. Reverse mortgage doesn't require monthly repayments. Frees up home equity for care or home modifications. Preserves retirement savings. Home equity line of credit. Lower interest rates than personal loans or credit cards. Flexible borrowing tied to home value, ideal for short-term needs. Uh, Sell lease back agreements, converts equity into liquid assets, allows homeowner to remain in familiar surroundings, simplifies financial planning with predictable lease terms, accessory dwelling units can generate rental income, supports multi-generational or caregiver housing, may increase property value and community cohesion. Long-term care insurance. Give me 1 second, guys. Shields retirement assets from steep care costs. Broad coverage across care settings. Helps plan ahead for chronic care needs. Life insurance with LTC riders. Dual purpose protection. Legacy plus care funding. Accessible even if standalone LTC insurance is denied. May cover chronic illness or cognitive decline. Okay. Uh, Vital. vi, Vital Life Settlements provides immediate cash in health crisis, avoids borrowing or asset liquidation, can help fund high, urgent high care, cost care. Okay, annuities with LTC benefits, guaranteed life or guaranteed lifetime income, can include inflation protection, bundles retirement with care planning, Medicaid planning, enables access to essential services for low income seniors. Estate and trust planning can protect assets, supports long term care, institutional or in home care, rent, renting out of renting out property, passive income stream, avoids asset liquidation, scales with demand and local markets. Okay, last page for A, folks. Family care agreements recognizes and formalizes unpaid caregiving, offers a path to fair compensation, strengthens intergenerational support structures. Each approach can fit different each approach can fit different care philosophies like preserving independence, aging at home, or reducing burden on family, which these reson- these resonates most with your goals for uh, equitable and person personalized care models. I'd be happy to dig deeper into or help map out when one might be preferable over the other. Okay, guys, so that is A for you. I'll be back on shortly with B. Give me a few minutes for B, please, and I'll be back on with that for you. For now, get our wellness. Take care, folks. I'll be right back on shortly.